Hey everybody, Yasin Nizami here with another weekly update on the real estate market in Canada, particularly in the GTA market, as well as some global macro indicators that we discuss on this channel, some investment strategies. If you are interested in any of these topics, consider subscribe, hit the like button and share with your friends and family, and we get back to our topic of the day. So this week I'm going to cover a few things that came out in the news media. Number one is the trigger rate. So as you know that in the past 2 years, a lot of people, pretty much everybody, has taken the variable rate mortgage because the delta between the variable rate mortgage and the fixed rate was quite a bit, including myself. I was deceived into by following Mr. Tiff Macklem's forward guidance and taking the variable rate mortgage. And pretty much everybody who has taken in the last 2 years, their trigger rate has been executed. For those of you who do not know what trigger rate is basically in a variable mortgage rate category, you have two options. Number one, your monthly payment is static versus your monthly payment is not static. It moves ups and down based upon the overnight rate set by the Bank of Canada. So in the first category, when the payment is static, when the interest rate goes up and down, the payment distribution between principal and interest, that kind of moves back and forth based upon the interest rate fluctuation, but your monthly payment amount remains static. But there is a limit. There is a limit when, if the rate goes above that ceiling limit, then your monthly payment is not covering your required interest. And if that happens, we call it's a trigger rate. When it is executed, then you're pretty much not even paying the interest required on the payment. So the bank actually increases your monthly payment in order to meet the minimum interest requirement. So in that case, you're pretty much paying interest only on your mortgage, and your principal is just sitting there as it is. So it will be a sticker shock for a lot of people who go into renewals after, let's say, 3 years, and they will find their principal amount is still static, still sitting there, and they just have been paying interest payments on their monthly mortgage. So that's a quite disturbing news, to be honest, and it was expected by looking at the aggressive rate hikes in the modern history that we have seen by Bank of Canada. And according to another news article, the amount of mortgage that has gone up compared to last year, to some extent, it has gone up by 250%. 250%. That is a staggering amount of increment in the interest payments that we have seen across Canada, and the households are being crushed because at the same time you're seeing the rising consumer prices with regards to inflation, food, oil, fuel prices, clothing, dining or eating out. Everything is going through the roof, grocery bills, and at the same time the Canadians are forced to pay aggressive amount of interest payments on their mortgages as well. So that is causing a lot of trouble for the Canadian household. As a result of that, a lot of lenders are being smart. They're trying to find some workaround for households to take more debt, right? So that they can continue sustain their housing bubble. So one of the options that the banks and the OSFI also considering is to extend the amortization, so beyond 30 years. So today the maximum amortization that you get is 30 years. They're considering to extend that to even 40 years so that the monthly payment of that mortgage gets reduced. So in the long run, you're taking more debt, but your monthly payment is getting reduced. A lot of people say that people really don't buy houses, they buy monthly payments. So the monthly payment becomes affordable. This is when the housing becomes affordable. So that's what the banks and the OSFI people are kind of exploring new options to make it affordable, kind of affordable, The other thing I want to share is you can't make this up, man. So Bank of Canada's chief, Tiff Macklem, he was being questioned by the parliamentary committee, and this is where he was asked how much money they spent on giving out bonuses to their employees. And back in 2021, when everybody was being crushed by the high consumer price inflation, Mr. Tiff Macklem decided to give out $18.4 billion only in bonuses to their staff. So they have around 1,600 something employees in Bank of Canada, and they spent $18.4 million just on bonuses. At the same time, he's dictating the union representatives and corporate leaders that they should not give out any pay rises or bonuses because it is inflationary. And at the same time, he himself putting $18.4 million in terms of giving out bonuses to their staff. So these rules are not for bankers. The bankers are above the rules. It's so these are the biggest source of inequality in the world today. The other news I saw this morning was the governor of Royal Bank of Australia. He apologized publicly that they put this forward-looking guidance out to the public, and public listened to it, and then public went on the borrowing spree. As a result of that, they took a lot of debt, and then there was a rug pull from under their feet, and Australians found themselves in a big mess, and he's now apologizing it. I was thinking when Tiff Macklem will come out publicly and apologize to Canadians as well. I don't know if it's going to happen or not, but he is the culprit of this mess when he openly said that we're not going to increase the interest rate until like end of 2023. So the people should go ahead and then take as much debt as they can because the interest rates are historically low. People listened to it, they took out mortgages, and that was the biggest rug pull from Bank of Canada in the modern financial history, like 400 basis point rate increase in the matter of 6 months. That is, I don't know what to say. So that's what happened, and they're gonna go another rate increase next month. The expectation is it's going to be 0.5%, and then they will take a pause, and they will see how things are shaping up. They will probably stay on that level before they can start reducing the rates, and it all depends upon the inflation. The official CPI figure is kind of staying constant. It's not going up month over month, so maybe this is a peak, but who knows? This is just one CPI readings. We cannot be so sure about that. So we'll see. If the inflation is kind of trending down, then we can expect that rates will also kind of come down at some point in the future. But anyway, this is where we are today. Things are still very tight. I have been very active in the market right now. We lost one property because the sellers are still in the mindset of waiting and getting more offers in the future, but the things are not getting worked out for sellers and buyers either, because buyers are not willing to pay too much because of the uncertainty. At the same time, we don't have enough inventory, and the sellers are kind of reluctant to reduce the pricing because what they have seen in the month of February and March, they expect things will come back next year, but I don't see this is happening anytime soon. Anyway, this is just my thesis, so let me know what you think. Put your comments down below. If you like it, give me a thumbs up, share, and I'll see you in my next video. Take care.